Improve trade entries with Wyckoff. Welcome to Power Charting. I'm your host, Bruce Frazier. This is a workshop. We are going to start with a few brief comments about the current market and then get on to a workshop on how Wyckoff methodology can improve and enhance your trade entries. And also, I believe, craft your strategy for which stocks to buy, when to buy them, how long to hold them, etc. Here is some brief comments regarding the current state of the market. It's such an interesting place at this time. And you can see here the fear and greed, which we've looked at in the past. Back in September of 22, it was at a very lowly reading of 14. Today, it's at, as of June 14th, it's 81. And that's important. We look for the high watermarks. Now, that doesn't mean this couldn't go higher. Let's hope that it does. But in fact, if we go back and look at the extremes of sentiment, and this is just one type of a measure for sentiment, is we see here in late September, October, the beginning of the fourth quarter of 2022, that the stock market was very, very low, had a really big decline from the August peak, and there was a tremendous amount of pessimism as the Fed was continuing to raise interest rates at a brisk pace. These red dots represent the areas where the market peaked out. You can see here the level of the market when the sentiment reached these extremes. This was high 60s, low 70s, and now the highest reading yet, above 80. Now, this appears to be, and the reason for this, I believe, is because the expectation is that the Fed will stop raising rates, among other things, but this has given some confidence to participants in the market. We will have a look at interest rates here in just a second, but I just want to keep you focused on the idea that we want to be operating in opposition to the extreme sentiment readings. We go with the sentiment as it's going up or going down, but we're very cautious about the extremes that it reaches, and we turn to our tape reading to know what to do, when to do it, and we'll look more at that here in a minute. This is the U.S. Treasury 10-year yield. This is a swing trading count of yield, and this where it says over here, say 28.00, that's 2.8%. That is the rate of the U.S. Treasury 10-year. At the time of this chart, June 27th, the rate was 3.747 at that time. Well, in fact, we have a bit of an uptick here, and so we see, we'll put a little check mark, that we're back to 38, and we are just a whisper, somewhere between 4 and 8 basis points away from touching 39, which would put an X in this next box, which you see would be a form of a breakout, and this is a breakout with a backup. We count the swing count here, takes us to 4.4 to 4.5% yield above this high that was made, and that would be potentially an up thrust. And so, excuse my penmanship, and these counts are so helpful, they're so useful. Look at this beautiful swing count here, 14 columns times one box reversal, and you can see, and then the scale here is 1, but you have to move the decimal point over, but for calculation you just multiply by 1. So it's 14. The count is 14 from the low and from the count line. We see here that we reached a reading of 4.2, 4.0, and that was very, very close, one box under the extreme count that it reached, which produced a range-bound condition. And that's absolutely beautiful, because this shows that, in fact, that's what happened. After that, building a new count now. If it can follow through here, it could very well make a minor new high. And that could coincide with the Fed. Chair Powell met with all the central bankers, I believe was 2 days ago or yesterday, and recording this on Thursday, and said expect a couple more rate hikes this year, even though they paused at the last meeting. Well, if in fact we do get 2 more rate hikes, it could very well propel the 10-year up to a minor new high. Oh, brief announcement. Roman and I recorded a Wyckoff market discussion free session on Wednesday. It was a great show. I thought it was quite good, covered current markets for many of the important markets that you may be interested or be trading in. And you can go watch this on demand now by going to wyckoffanalytics.com. You can see the website for the this page here, and then you can click on this button and you are on your way, and you can watch part or all of that. I thought it was a good show. Now, turning to seasonality. Seasonality has worked quite well. We've been looking at this chart since the very beginning of the year. We saw that, in fact, there was an upward bias for the first half of the year. This made perfect sense. And so here we are approaching the end of the second quarter now, and this is the Nasdaq 100 superimposed over our seasonality. We look for directionality, not extent. So we're more interested in where the trends are. And in fact, they were very close. It looks as though the trend peaks were coming a little bit early. That could be the case here, but it's possible that we could get into this mid-July period, which would be in the quarter end window. And then after that, range bound. Now, I have a feeling here, look at that beautiful spring and then upward bias into the end of the year. And then now this is for pre-election years only, going back 73 years. I believe that as we look at this, that we may be seeing in the third quarter actually rotation, and the rotation could be away from these Nasdaq 100 names and into other more industrially, economically sensitive areas of the market. We've talked a little bit about that previously, and we will do so again in the weeks ahead. But this shows that we have a range-bound market for the Nasdaq 100, and this could, in fact, rotate some funds away from the very, very overpriced Big 8 stocks and the other big growth stocks that have done so well in the first half of the year, and towards other areas of the market which are starting to catch a bid. So we will keep an eye on that. Now, just for the heck of it, let's look at the S&P 500. S&P 500 has been a little bit more of a laggard in comparison to the Nasdaq 100, and it's more associated with more of the economically sensitive stocks, even though the big 8, I think, are all in the S&P 500. And you can see here that the peaks have been maybe slightly early, but look at this beautiful advance that we had at the end of the second quarter, and now we've turned off of that, have another push up, range bound. Again, this is the same seasonality chart, and so we will keep an eye on that, but I wonder again whether rotation might be the story in the third quarter, and we will know by looking at the tape, watching the tape. Speaking of which, let's look at a form of breadth. This is the Bullish percent index. This is all of the stocks in the Nasdaq 100 stocks, and it is using the Bullish percent concept, which is counting the breakouts of the point and figure charts for the individual stocks. So each stock gets an equal vote. Note here that the January rally had much better Bullish percent breadth than did the March rally or the May rally or the June rally. So you can see diminishing thrusts in the bullish percent, which in fact, in my mind, means that this is a market that is narrowing. And so we have a narrowing market away from many of the stocks, even in the Nasdaq 100, that aren't the mega cap, super big companies like Apple Computer, which is approaching a $3 trillion market cap. And here you can see the acceleration here, which has somewhat of a climactic quality to it, into the highs that were made mid-June, end of the second quarter, as we approach the extreme of seasonality. And we see that the internals of the market are really not expressing the internal strength. We will look for rotation, see if strength is coming into other areas of the market that are away. I think there's logic for this because I do believe that many of these institutional investors that are overweighted the Nasdaq mega cap stock names are not, they're always going to own them. They're never going to really under own them in a bull run, but they have had so much appreciation in the first half of the year that they raise cash and reduce allocations somewhat, even though when you look at the allocations in their portfolios, they're still dominant over capitalized or overweighted stocks, as is the case in the big indexes like the Nasdaq 100, which is a cap weighted index. Now let's turn our attention here to our workshop, our case study, and talk about entries. We are going to reference a power charting blog that I wrote back in 2016. You can go back into the archives, read these blogs, look at these charts, etc. And I want to, let's see, do I have my pen here? Okay, so here, this is the case. This is schematic number one, which is a schematic which shows a spring, which is a slight breakdown below the secondary test in phase B of an accumulation structure. Actually, the example we're going to do today is not a schematic number one type stock, but this is a very good example, and it makes a very good point. One of the things I want to emphasize is that once you get a selling climax in an automatic rally in phase A, then you can draw resistance and draw support. These are such important tactical methods that you have in your toolkit, because anytime you break the selling climax with a secondary test, as is the case here in phase B, that is where the institutions, the composite operators, the super duper smart composite operator types, will identify this as a value zone. The reason that they see that here is at this price level is because of the outsized rally that was able to follow the selling climax. So they see other investors, or maybe themselves, as buying at this level and supporting the market. And so they expect the market to be supported again in this price zone. And so they will continue to buy shares all the way through the support area, not what a Wyckoffian will do. We want to get on board with the composite operator types when they are done accumulating. And at that time, we would say that the market is absorbed. And so this is, and the reason that we want to wait is because note what happens after we get that final testing in phase C here, which is the final test of the lows, and then phase D is the final rally into resistance and the beginning of the uptrend, which we call phase E. These are such good concepts. Test of the spring. For those that are, I'd say more aggressive, is a place to start to or initiate purchases. And my preference is to see the spring, the test, and then a good demand bar off of the test, which shows that the support is in fact holding, and the big strong demand bar shows that the market wants to run up back towards resistance again. The speed of the advance of this move from phase C lows to resistance is a huge tell about how the market is going to act going forward. And then the inability to have a big, deep reaction back into the structure after this strength is a very important tape reading clue that this is an absorbed stock that now is in the very strongest hands. Difficult to buy in quantity for institutions. And so they will start to buy on the way up. The composite operator types have been systematically doing their absorption all the way through the accumulation zone. And so they are the ones that have absorbed, where the other institutions are following along afterwards. And these institutions are, really, for the most part, very, very good at what they do. The ones that follow the composite operator types, because they are getting in early as accumulation is completing. The other institutions will come on later and later as the uptrend is defined. So keep that in mind. And the entry points are on the spring, on the last point of support, more on that in a minute, and then on the backup LPS, which is off the jump across the creek, which starts the uptrend. Here is an example from the blog on April 15th, Power Charting blog. And you can see here, keep this chart structure in mind, because this is very similar to the case study we're going to do in just a moment. And this is a 30-minute chart of the Dow Industrials, vertical chart. You can see the selling climax with volume, automatic rally. This rally is much better than the previous. Resistance is formed, support is formed. This becomes the range-bound structure that occurs. This is only over the course of a few days. You can see preliminary support here, beautiful bar with a tail, very huge volume, which shows that there's some demand here. And then systematically in the value zone, the Dow Jones stocks are being bought in this value zone. And then here we see the phase C low is the LPS, which does not spring, does not go to a new low. And look at this this bar here is the LPS low, a very good bullish bar that completely takes back that decline. And then a test occurs thereafter. Look at this beautiful demand bar that follows, which is the test of these two prior lows. This is the place to, in my estimation, to get busy, is to start to participate on strength off the LPS low. The backup, and you can see how beautifully the backup stays at the resistance and holds, cannot go back into the structure. Absorption appears to be complete. This area can be bought as a breakout, and also on the strength of this particular bar, you can buy the strength as it starts to move away from this congestion zone. Okay, so study that chart. Keep this in mind as we look at our case study. One last case study, which is Albermarle, and this is very similar to the stock we're going to look at today. Selling climax, automatic rally, resistance, support. Look at, even though it upthrusts the automatic rally peak at resistance, it fails miserably back down to the value zone below the selling climax lows, builds a little swing count in here. And for those who are bold and care to trade these areas with the CO, this is a place where you can initiate on this pullback here, and then the strength off of the test of that low, and you get a nice little trade, swing trade here in the month of October. But I think the more important opportunity is when you get over here. Look how resistance at the automatic rally peak produces a sign of strength followed by another return back into the accumulation zone. And here, and this becomes our count area for our initial count. You can go look at the blog to see that point and figure count. But here you see the LPS low and a test, and then here's a really good bull bar that turns off of that, and up it goes. One last LPS here, a test, strength thereafter, follow that up so you have a buy zone LPS 1, a buy zone at LPS 2, a buy zone at LPS 3, and you can see with the resistance that forms here, attempt to go up, pulls back one bar back to old resistance, new support, can't stay there, and immediately gets busy and goes into an uptrend. Now, all of this is considered to be completed accumulation upon that run up, and this shows absorption, ease of movement in the upward direction. This is the beginning of something more important. Here is our case study for today, and this is Palantir Technologies. This is up to date through June 27th, end of the quarter. And just to emphasize here, relative strength underneath, I think that's very valuable. Selling climax low, then an automatic rally, resistance and support. This is the value zone. The secondary test comes down here, and it is being bought in the $6 area. Upthrusting action above the automatic rally peak, and then a very sharp failure, a test, and a return back into the accumulation zone. Then another sign of strength action after the secondary test, which goes to the resistance of the automatic rally, returns back in. Note that this stock cannot go back down to support after this. Two attempts to go down here and here. The volume is diminishing, showing that there is a lack of supply available as the stock is being fully absorbed. Then this gap is earnings. Note the hinge type action here that's taking place and the jump up and out of this area. So LPS, a one bar of strength, you may have missed that, but then at resistance, it backs up one time. This is the jump across the creek and the backup for a test. Very low volume you see here, this yellow area, and then it just starts to run, and the resistance zone here is a classic place to get busy and accumulate shares, because look at the near verticality of this advance. And so I put these delineation lines. This is phase A, phase B, phase C, final testing phase, and then phase D and E here. So a beautiful chart structure, wonderful advance from around 9.5 here up to $17. Now we see here a somewhat of a climactic surge, volume supply coming in at this level, a tail in this bar, then a test and a return back down. So what should we expect next? Here's a swing count. We'll go quickly here. We're running out of time, but a swing count here shows this objective of reaching 15 to 18.5. You saw we went to 17. So, and then in a congestion zone, I think this is possible reaccumulation. We'll watch, we'll see if this 14 area provides good support, can go below 14 as it goes sideways through this area, but we look for another count to build here, and this count would lead to higher prices. We always want to watch for larger counts. Be aware of bigger counts over here. And so let's look at the bigger count. And here we have a stride that takes us a steep stride this high, this high. I love to draw trend lines on point and figure, and then it comes up, crowds into this trend line, and then goes above it, attempt to test from above, and this is called a catapult wall. Here is a bigger downward trend. I'd also like to point out that there's distribution forming up here, and this count I think went down to $9, I think is where it went, so pretty good count. And so here the catapult wall just shatters the downward stride of that trend line, and this is where we are now. Let's take account of this area. We see that this is a beautiful accumulation structure kind of account. This is the area we just evaluated. 15 columns, 3-box reversal method times a half. That's the scaling here. Gives us a count of 22.5. And we count from the low and from the count line, and that gives us a count objective of 28.5 to 30. That is still a substantially higher level from where we are. I would expect a reaccumulation in here to consolidate and then be able to turn up from this area, and then we will see whether reaccumulation is showing good support, good demand for a run up to this level, and give us a count to that level also. Keep in mind also that this could be a bigger count. And so here's our chart notes for this, and then we'll sign off. Distribution formed, big markdown occurred, went from 42 down to 6. Downward stride was reversed on 2 levels. Accumulation structure formed thereafter, which is exactly what we look for. And then we have a beautiful catapult wall, which is that incredible restriction of supply, absorption of shares, which allows a stock to move abnormally upward after an accumulation. And this is the reason it happens that way. Absolutely a brilliant concept from Mr. Wyckoff. Larger count is possible. And so keeping those things all in mind, there we are. That's what we have for today. I hope you enjoyed it. And if you really, if you like these case studies, give me a thumbs up in the video. And also, if you have ideas for future case studies, I can't cover them all, but please, put them in the comment section there, and we'll have a look at it and see whether or not it really fits the Wyckoff process, and we could do a case study on it. And with that, thank you so much for being here. It's always a pleasure to be with fellow Wyckoffians and future Wyckoffians, and we will see you next time.